Great, thanks everyone. Let me start with a quick round of introduction, and then I'll hand over to Richard, Stephen and Sid to also introduce themselves. So my name is Kelvin Ko. I am one of the co-founders of Spartan Group and also CIO for our asset management business. And prior to starting Spartan, I spent 20 years in TradFi. I was with Goldman for 18 years and led the firm's research business in Asia. And thereafter, spent about 3 years working with a US-based hedge fund that was based out of New York and started by two former managers that came out of Soros. So I'm quite well acquainted with the world of institutional finance. And at Spartan, we have three business lines. So I mentioned our asset management business, which consists of three funds. So we run a long-short fundamental hedge fund strategy. That was our earliest fund, which now has been running for 5 years and is up over 500% since inception. And we also have two venture funds, one focused on the DeFi vertical and another one focused on gaming and the metaverse. So in aggregate, we manage about $350 million in capital today. Our second business is our advisory business, which helps crypto startups to raise capital and do M&A and restructuring. And we were early backers of projects like Solana and the Flow blockchain, as well as Blockstack. We helped many of these projects raise funding during the last crypto winter that subsequently allowed them to thrive and become what they are today. We have also worked with other large ecosystem players like Bybit Exchange to create BitDAO and then Mental, and also are working with BitGo, as well as a few other major crypto projects. So that's my background. I'm happy to pass over to Stephen to introduce himself.
Yep. So my name is Steve Richardson. I'm managing director for our financial markets business at Fireblocks. Fireblocks is an institutional digital asset infrastructure company. We really focus on providing best-in-class wallet infrastructure and other tooling for institutions to be able to offer digital asset products. We work with large banks like BNY Mellon, ABN AMRO, NAB, ANZ, et cetera, but also work with payments companies and the likes like Visa and WorldPay and others to basically enable really interesting use cases along the lines of digital assets. So very happy to be here today.
I'm Sid. I'm the co-founder and CEO of Maple Finance. We're an institutional capital market. So the way to think of what we do is it's like a platform to lend to institutional borrowers, which could include trading firms, fintech originators, but it broadly covers digital assets and real-world assets. My background prior to entering crypto was working at a bank. I actually worked at NAB in Australia, which is one of your clients now, Stephen. And so I saw the institutional perspective on debt markets, and this was helping large lending companies to borrow. Maple's tried to recreate this on-chain, and we've done about $2.2 billion in origination since we launched in May of 2021. Increasingly this year, we've kind of diversified the lending verticals. So we do tokenized T-bills, we do loans to trading firms that are collateralized, and then we do real-world asset lending. So this is like loans to small businesses in the real world, but it's all in the efforts of having an impact on the real world using DeFi rails. So very happy to be here.
Great, thanks for that introduction. So the last 12 to 18 months obviously has been quite a trying period for the industry. And it's kind of crazy to think that FTX was less than a year ago. But notwithstanding everything that's happened, it's great to see the interest in the space in general, especially also seeing that the institutional interest in particular has not been significantly dented by everything that's going on in the space. In the last few months, we saw announcements from some of the largest asset managers in the world, the likes of BlackRock, Invesco, Fidelity, and others, to create ETF products. What do you think is behind this surge of interest?
I think the space has come a long way, and this is how capitalism should work, where these large ETF providers have seen that the space has grown large enough and that their clients want this type of product. And previously they were barred from offering it to them, or they didn't have the internal processes set up for it. So I think it's largely profit motive and just doing what they should do, which is serving their clients' interests. I think the interesting part is these are spot BTC ETFs that are proposed. So it's very much kind of like entry level for crypto. And so the question for those of us in the space is, how do we then progress that interest so that so that we could soon see BlackRock or Blackstone, a very large, very reputable firm working with DeFi rails, whether it's credit on chain or whether it's using other financial products, but settling it on top of the blockchain and actually interacting with smart contracts, which is probably a phase 2 or phase 3 in that kind of institutional adoption. And I think what we have to do to get that interest is to show that it can be lower cost. So really almost appeal to their client base through lower costs, liquidity, transparency, instant settlement. And so I think that's kind of what we need to emphasize.
Yeah, look, I think it's been a journey for sure, right? I mean, obviously regulation is coming to a place where people feel they can kind of operate in this space. I think secondarily, a lot of the kind of the operational elements of operating within digital assets have slowly been figured out over a period of time, right? The broader ability to acquire the underlying asset, the ability to reconcile that asset, the ability to then offer products that allow folks to be able to use it. So for institutional folks to come into a space, right, if you think about why you use a prime broker, or you think about why you go to a large bank, right, a lot of the middle office and back office and the reconciliation work that's required to be able to do that is done quite efficiently, right? If you think about really operating in the digital asset space as a norm, you talk to people, they have to find the right folks to basically enable accounting, tax implications, middle and back office implications. It's a whole journey, right? And so you're now seeing like a more comprehensive product suite come into the space that I think makes it easier for folks to be able to jump in. And then to your point, Sid, the money is there, right? That now allows it to make sense. I think in order for things to then progress into DeFi, you basically need to have some level of harmonization that allows what happens on chain to be translated into the type of regulatory and reporting requirements that they have off chain, right? And once that's solved in a real way, I think you'll start to then see this transition and more interoperability between centralized finance and decentralized finance really happening.
Got it. And you talked about some of the things that these institutions need to come on board. In your mind, are there certain impediments today, besides sort of this, reconciliation and sort of, all the back office settlement that needs to be done? Are there other impediments in your mind that is preventing these institutions from coming into the space?
Look, I think maybe from an infrastructure side, obviously understanding wallet infrastructure and all those components is relatively complex, right? So when we went through the journey with like folks like BNY Mellon or NAB or ANZ, right, there's a huge process that goes in place to be able for them to offer that infrastructure as a whole. I think you have great custodians out there that are making it much more seamless for folks to be able to operate, and that's one methodology of going about things. There's self-custodial infrastructure, and really for that, it's building the stack together, right? If you're a crypto OG, I think you probably remember the fact that you have to figure out your wallet, then you have to connect to different exchanges and venues, then you maybe need to figure out where you go to TaxBit or someone else, then you need to figure out who's gonna do your auditing and report. Like, there's just this massive stack of basically external factors that if you think about traditional finance, you go and you onboard with Citi or JP Morgan and it's all taken care of and you figure out that Ernst & Young is your auditor, right? I mean, it's not a very complex stack. So I think basically there's a lot of, let's say, broader integration that we're doing on the infrastructure side to find best-in-class providers that do these different things and seamlessly integrate their services into our wallet stack to then be able to make it easier for folks to be able to operate. But you're seeing custodians also take this tack of providing a kind of a wallet infrastructure in a box, right, that enables them to then more seamlessly be able to get out of the gates.
Yeah, I think Steven makes some great points around the infrastructure side of things. I think wallets and key management is certainly one that's going to be obvious and also will take these firms a long time to kind of get around. So I think whether a solution is Fireblocks or an MPC like that, or whether you start to see applications building wallets internally, like inbuilt into the app, I think is another way of improving the user experience and potentially outsourcing the security away from your institutional partner and more to you as a vendor or service provider. So I'm pretty interested in that. I think we've seen some interesting developments there with kind of account abstraction and inbuilt wallets, as well as authentication. We're actually just building in third-party authentication for Maple now. So instead of just connect your wallet, which is kind of the standby for the last couple of years when you use DeFi, you can log in with an email, get reporting, get account management. But I want to also shift and focus on the kind of the commercial aspect. So ultimately, there has to be a big profit motif as well for these firms to come in. And I think since last year, a lot of the returns, aside from just having a Bitcoin spot ETF and AUM management fees, the returns from actively participating in DeFi or in other subsectors of the space have kind of gone away. And so we need to see kind of profitable activity entice these firms to come back, and whether that begins with real world assets. Rune from Maker was here before talking about that, and I think if you see firms that can see the ability to do, whether it's private credit on chain and get maybe 13 or 14% versus what they could get in traditional debt products, that's one way that we look at trying to entice them to come on chain. But that's ultimately going to be one of the strongest motifs to get them to invest the work in setting up that infrastructure. If we don't have the profit motif, it's very hard to get them to invest in the operations.
Stephen, I think your point about sort of the operational setup, and how to get that the onboarding process was right on point. I remember when we started our first fund 5 years ago, and we were one of the earliest sort of liquid funds out there. We couldn't find a custodian that could custodize the range of assets we wanted to trade. The fund administrators had no clue about how to administrate crypto assets, and so it was just a pain, trying to assemble these different groups. But eventually, we managed to find something that worked at least for a while until the industry evolved. So I think it's a lot easier today, but it's still nowhere close to what the traditional experience is, where if you're launching a fund, you go to a Goldman or a Citi, and then bang, everything sort of gets set up for you, right? I think we'll get there in time.
One of the interesting ones that I think often kind of goes a bit unnoticed is as well fiat on and off ramps. So if you're a Goldman, currently you can't hold a stablecoin to actually do anything in DeFi or on chain. So once we have kind of, I guess, guidance and permission for banks to participate in the space, which I think is probably leaps and bounds ahead in the APAC region, then you'll be able to see more institutions come in, because they won't have to worry about what if the stablecoin depegs.
So speaking of sort of interactions on chain, to your point earlier, Sid, I guess as a crypto native fund, Spartan, we sort of use these DeFi protocols, right, for risk management purposes, to enhance our yields and so on and so forth. So to us, it's pretty second nature now, because we've been doing that for the better part of the last 3 years. But for some of these other TradFi institutions that are coming into the space, how well acquainted with DeFi are they, and also how acquainted with the risks, of sort of trading and managing assets on DeFi protocols, do you think?
Huge variation is what I would say. There are some who are quite far ahead because they have individual teams who would be aware of some of the large DeFi protocols, which I think is something that you couldn't have said a couple of years ago. But, I see folks at Citi, Goldman's, who have like a very comprehensive, quite advanced knowledge of DeFi protocols. So whether it's Aave, Compound, Maple, Maker, Uniswap. And so I think there are folks there who kind of conceptually understand it, but then it's another step from being able to kind of theoretically talk about it to either having used it yourself in a personal capacity, and I think some of them have, but then being able to propose a framework for an institution to use it. Right. And I think from 2020, we were left with this kind of baggage that a lot of the space is kind of perceived as a vehicle for speculation. Speculation is important in all new financial innovation, dating right back to like railway bonds and railway equities in the mid-1800s. But what we need to be able to show is that their clients want to use these products in a safe way. So, an immediate catalyst might be that if Citi's private wealth clients were asking to be able to trade assets on Uniswap or acquire some of these altcoins, then it's going to prompt these institutions to start to develop more of that expertise. But from the research reports that I often see coming out of these institutions, I would say they do have generally a pretty comprehensive knowledge.
Yeah.
Look, I mean, you can look at Project Guardian that happened in Singapore, right? I mean, they leveraged. There's a difference between in my mind, the underlying technology, right, the ability to leverage tooling, and kind of how it operates in the space today. At which point they have to think about regulatorily how they can interact, right? So when we sit with the regulators, the first question they ask is, how do you know who you're settling with, right? I mean, in general, in traditional finance, the idea of knowing who you settle with and who owns like the final settlement risk, right, to make sure that a trade goes through. And who do you go to in the case of a trade break or reconciliation issues? All of these different things are concerns that banks have. I think on-chain identity is the biggest concern that a regulator has, right? In terms of who are you interacting with, who are you settling with, and how do you know that they're not operating on an illicit basis, right? Those are just generalized questions, right? The underlying technology, though, I think they think is interesting. Right, the idea that you can get rid of intermediaries, the idea that you can settle point to point, the idea of on-chain DVP of assets happening. You're seeing that experimentation happening within BIS. You're seeing that experimentation happening within Singapore and MAS and what they did in Project Guardian. You're seeing it happening, within different innovation centers across the globe. And so they are relatively familiar with the underlying technology. I think they think the technology is interesting. They think the technology has an opportunity to really create more efficiencies, reduce costs, all those different things. I think they have to make the mental hurdle in their mind from a regulatory perspective, right? And I think there are a lot of firms in the DeFi space that are doing things the right way, that are operating consistently, that are thinking about broader regulation and what it means. But for banks, right, crypto as an asset class is a small portion of their overall portfolio. They're not going to risk, the broader business that they have to enter into a space that they don't know or is undefined in the ways that regulators think it's undefined. So I think the more regulators are able to understand and grasp, the more we see tools and technology like on-chain identity come into play. We've seen things like Aave and others where they're creating different pools that are or permission pools based for different institutional participants to solve that, in effect, knowing who you interact with basis. I think then we'll start to see some trajectory there in my mind.
Yeah, I think that's interesting. Unfortunately, like Aave, that experiment didn't really end up succeeding. But overall, it's a pretty large mental leap to go from kind of the traditional financial system. It's when you break it down, it's largely based on just the acceptance of counterparty risk. You either settle with a person or you take the counterparty risk of the clearinghouse and accept their balance sheet risk that they will enforce the trade. But either way, you're relying on somebody's balance sheet to absorb the risk. DeFi is more akin to having terms of service with like an email provider. You don't enter a contract with Google to make sure that your email reaches the person that you're sending it to. You just accept terms of service. And so that will be like a mental model shift for traditional firms to undertake. But you can already see that in some of the case law, like the last Uniswap case from a couple of weeks ago, where a class action was dismissed on the basis that it's like holding the creator of a self-driving car responsible for its misuse. And I think it's starting to come through in some of these judicial decisions. I'm interested. I think one of the most interesting things happening in the space today is what's happening with the stablecoin providers' profits. You saw the other day, Tether announced, that they're, I think now a top 22 debt holder for the US government. And so if I'm a bank, I've got to be looking across at that and going, that's a deposit product where they pay zero interest to depositors and keep the entirety of the returns from investing those assets in pretty low risk government securities. And so I think that's that's one thing that could drive banks into the space and to adopt a more kind of progressive mindset to it.
Yeah. Yeah, I think for now, at least, the banks are still, I think, more focused on trying to tokenize traditional assets and sort of bring it on-chain, right? But speaking of, going back to your point about Goldman, they do obviously have a pretty large, digital assets team that, we're in conversations with. But, even going back as far back as 3 years ago, I had a call from somebody very, very senior in Goldman on the management committee, and he had learned through some of our investors who are Goldman partners and MDs that we exist, and gave me a call and said, hey, we love what you guys are doing in the space and want to learn more. And when I asked him, when I probed what his interest really was, he said, well, I know you guys are investing actively in DeFi, and we have a team of people, developers and researchers that are looking into things like synthetics and Aave and Compound and Chainlink and so on, and we think it's fascinating. So they obviously have done the research, not to say that they're going to use it anytime soon, but they clearly are monitoring everything that's going on. And eventually they wrote a check into our fund and said, we want to know everything about all of these other new protocols that are going to come, right? And we think we'll get that through your fund. So it's interesting to see that level of knowledge. But besides the banks, what are some of the other sort of institutional investors that you guys are seeing interest, from to come into DeFi and crypto?
It's a mix, and I think one of the interesting aspects is the important role that funds like Spartan play in helping to educate the larger traditional funds, not traditional funds, but traditional institutional allocators and investors. So a large pension fund or endowment or somebody like Temasek is not necessarily directly going to go into a DeFi protocol. They're not going to deposit liquidity or own the token, but they might commit LP checks to funds like Spartan who are very progressive and forward on the DeFi side of things. And then that helps kind of, that's an investment in education, because then they attend the meetings, they start to ask questions and get really thoughtful about how the DeFi space is evolving. We talk a bit to large endowments and pension funds. Ultimately, in my ideal state, 5-10 years from now, they would be direct participants in DeFi protocols like Maple. They're the biggest fixed income investors in the world. But in the near term, I think where we see the most institutional interest is coming from smaller hedge funds who might have some of those large players as LPs, and they have flexible mandates, and they also don't have a reputation that they need to protect. And I don't mean that in a cynical way, but I mean, if you're a $40 billion asset manager, DeFi is going to be a tiny part, DeFi or Web3 is going to be a tiny part of your revenues, but a huge contingent liability on your reputation. So it's these smaller hedge funds and breakaway asset managers who I think we try and focus the most time on getting them on side and getting them educated. And then I would say also family offices, because they have flexibility in their mandates. And typically there is one or two decision makers. There's maybe a portfolio manager, or there's the principal themselves who represents the family money. And so we've started to see some activity from them, whether it's holding tokens directly or whether it's putting money in pools like Maple or like Aave and trying to earn a yield. For a lot of these firms, a lot of the focus is they've already made their money, and so they're not necessarily looking to shoot the lights out with 20% returns. They're looking for capital protection and steady yield income. And so I think that's where you can entice them with this idea that maybe there's some extra yield pickup in DeFi. There's transparency, auditability. They can trace what's going on, and also maybe more liquidity because of the tokenization factor.
Got it. Anything to add, Steve?
Yeah, look, I think from my perspective, right, we're seeing a lot of activity on the broader tokenization side, right? So obviously people were quite interested after Franklin and Templeton tokenized that money market fund. And we're broadly seeing a lot more institutional players think about tokenization on a larger basis. I think for us, it's been interesting to look at places. When we started like the journey of offering tokenization at Fireblocks, we started with banks, right? We said, okay, look, go to Bank A, build tokenization in a box, enable asset managers and others, providers to come to tokenize assets within your bank. The banks were like, we're not ready for that. Then the asset managers themselves, right? If you look at what folks like KKR have done, they started the exploration of tokenization as a whole, and we've seen more interest in that way, right? We've seen actually the asset owners start to think about unique mechanisms for tokenizing assets and expanding the markets that are available to them. And I think that's become a very interesting play, right? And I think the really unique thing is, if you think about what's happening in Korea from an STO perspective, whether or not you're going to see more tokenization of funds and how that gets eventually offered into retail, whether you're not going to see more tokenization of other real-world assets like real estate and other things that start to happen, and whether that then starts to make itself available within the broader DeFi space. So if you think about it, really, the DeFi protocols are the ones that basically determine what can be used as collateral in any basis, which then drives the utilization of that in an alternative market. So I think really, this idea of real-world tokenization of assets and really the asset owners then driving those assets into this ecosystem and then proliferating that into retail and other institutional players, I think is a really interesting dynamic to watch over the next year.
Shifting gears slightly to talk about sort of the regulatory landscape, because that's topical. So far we've got MiCA sort of rolled out in Europe. We've got regulations now in Hong Kong. Korea sort of also advancing on that front. And notwithstanding the SEC sort of crusade, there are serious regulatory discussions going on in Congress. So how do you think that the regulatory landscape is going to evolve, and how will that affect crypto and DeFi in the coming years?
Look, I think it's been interesting, right? So you have what's going on in Hong Kong with SFC. You have VARA in the Middle East. You obviously have MiCA and that. I think there's a difference between the underlying asset itself, right? So if you look at what's happening on the real world asset side of things, we're seeing more of a play towards if the asset exists today, its tokenized form will be treated in a very similar way, right? I think that's a very easy process to understand for folks, and banks are understanding like the broader risk management and what that means. I think on the pure crypto side of things, or maybe on the DeFi side of things, I think the regulators are still wrapping their heads around what it means in the underlying the broader systemic risk that potentially exists. I think there are more progressive regulators in my mind, right? I think SFC is trying to be progressive. Singapore is trying to be progressive, and then VARA, obviously, that's fully focused on digital assets, is also trying to be progressive. I think they are worried about basically exposure to retail. They're worried about who do they hold accountable at the end of the day. I think that's what I hear from the regulators all the time is we want to understand who to hold accountable. And until they really figure that out, right, there's still a little bit of work to do on their side to create comprehensive legislation.
Their enforcement actions at least suggest they have some idea who's accountable. No, I think, regulations vary. It's a bit of a mixed bag at the moment. Certainly varies a lot across jurisdictions. I'm perhaps optimistic in my view that the US will get it right eventually. I think MiCA has shown, Europe is willing to take an early lead there. And we still have a period of time before that comes into effect. And it does treat decentralized protocols and infrastructure differently from digital asset service providers, which have much more onerous obligations. But I think also APAC definitely notably has taken an early lead there and has been really good to see the willingness of banks and other institutions in Hong Kong to support crypto companies. I think as I look at the US, it's been good to see, I guess, the three-pronged approach where you have the legislative body, the administrative or executive body, which is, of course, the SEC, and then you have the judicial bodies, the courts, and the balance between the three. So really, over the past 12 months, we've kind of been relying on the court system and the legislative body to support crypto, whilst the executive has been a bit on the aggressive side. And I think what we're seeing come through in the way of legislation is encouraging, and makes me think that we will get there eventually in the US. And of course, that is the world's largest capital market, so it's one where we do want to make sure we get a good result. It's prompted us to, we still try and do business with clients in the US, albeit we have to do it in more of a way of working around, exemptions and sticking to accredited investors or institutional clients. It's not something that can be made available to retail. But part of the reason we're here is we are trying to build our presence in the APAC region because of how far ahead they are on the regulatory front. And so I think Singapore, Hong Kong, Korea, Japan are all very exciting markets from that perspective.
Got it. Well, I think we're running out of time, but to wrap up the panel, I'd say that 5 years ago when we started our journey, with Spartan, a lot of our friends from TradFi sort of looked at us as though we were crazy, to put it nicely. But today, I think individual investors have accepted crypto as an asset class, and we're on the verge of institutional adoption. So I'm pretty excited about what the next 2 to 3 years holds for the industry. Thanks, everyone.
Thank you.